Let me just tell you about my experience. We at the time bought 6 houses, I think, between 2001 and 2006. The first house, Norris Drive, which I talk about all the time, was a traditional mortgage. You go to a bank, you fill out an application, 20% down, they validate this, they call your employer. It was a true, loan. If you fast forward to my last purchase, which was in, I think, early 2006, Jason, I signed a blank loan application. Yeah. Everybody talks housing crash like prices, right? Mm-hmm. We've got Pretty Chart Boy and all his brothers in arms talking crashes for years now. They don't know what they're talking about. The reason 06 happened and then 08 and 10 happened is because it was cheaper to rent, and in many cases, a lot cheaper.
And welcome back. In today's video, I'm joined by Michael Zuber of One Rental at a Time. Welcome to the channel, Michael.
Jason, thank you for the opportunity. I look forward to this conversation. 2 California investors, so this should be fun.
There you go. Yeah, I'm not an investor yet, but this is one of the reasons why I want to bring you on the channel, advice for people looking to buy their first rental property. But we have a lot to uncover in today's video. So yeah, we're both located in NorCal. So for people who may not know who you are, I know we probably share a lot of viewers and subscribers because you do have a YouTube channel, which I'll provide a link below for that. Maybe you can provide, who you are and what you do.
Yeah, my story as a real estate investor actually doesn't start till I'm 30 years old. After I lost a lot of money in the stock market, I turned 7 grand into 200, only to lose $160,000. At which point I knew I wasn't going to be the next Warren Buffett, and I needed to find a different way. So I found Rich Dad Poor Dad, which really set me on an entirely different journey. I am that person that believes the W-2 employee can have a better financial future. I believe most people should just get to 4, right? That's all it takes to have a better retirement is 4 rental properties. If you want to go bigger, go ahead. But I think talking about 10, 20, 100 is nonsense. Let's talk about a number that everybody thinks they can get to. And I think 4 is a great number. And yeah, I successfully started buying in 2001. I bought before the crash. I was involved in the crash. I bought after the crash. And we could talk all about that because I know a lot of people who weren't investing then think today is like yesterday, and nothing could be further from the truth. So I've been doing this a long time.
Awesome. That's a great intro. And so, yeah, I'm really curious. I mean, I bought my first property back in 2005, and I bought, properties thereafter. And the experience of applying for a loan is so much different now than it was back in around the Great Recession. So, how easy was it to buy a house around 2005, 2006?
Yeah, so 2006 was absolutely the worst year, the worst vintage for mortgages. So let me just tell you about my experience. We at the time bought 6 houses, I think, between 2001 and 2006. The first house, Norris Drive, which I talk about all the time, was a traditional mortgage. You go to a bank, you fill out an application, 20% down, they validate this, they call your employer. It was a true, loan, very much like today. It wasn't quite as easy with approve eligible and all of that automation, but it was a real file, right? You felt like you were going through it. If you fast forward to my last purchase, which was in, I think, early 2006, Jason, I signed a blank loan application.
So your loan officer just gave you a blank application and just said what?
He said, Michael, sign it. At which point I said, because, again, it got progressively easier.
Yeah.
And on the 6th purchase, I said, I'm not sure I'm comfortable with that. And he said, again, in hindsight, I now know it's a lie, but I didn't know any better because I thought he was a professional. He said, don't worry, Michael, we have your file from the last several loans. And
wow.
I had I was busy raising a daughter, traveling all the world. I didn't have time to keep questioning him. He was the professional. He was getting paid, and I trusted him. But in hindsight, looking back now, who knows what they filled out? The lending in 2006 was, I don't know what word is worse than horrible, but yeah, signing a blank loan application. I think if you watch the movie The Big Short, one of the scenes talks about, they're knocking on the door, they find a tenant, they say a name, and the tenant says, oh, you want my landlord's dog. That's how bad lending was back then. So yeah, 2006 lending, I hope we never see something like that again. Not to mention the most toxic loan product ever created, the pick-a-payment, 30-year, 15-year interest only. Oh, let's do negative amortization where we throw the debt on the back of the loan. That's got to be a good idea. Bad, bad, bad. Toxic.
For those who do not know what negative amortization is, can you explain what that is?
Yeah, so let's just say your fully amortized payment is $1,500. Let's just use that number. And what a neg am loan would be is they'll say something like, you know what, pay us 700 and we'll throw the 800 on the back of the loan. So it's a payment that's not even a real payment. It's like a partial payment. And they put the debt on the back of the loan. Why? Because everybody believed housing only goes up. This was the time where housing only goes up. I would go to events and it was crazy. I mean, people in the Bay Area were buying condo lots, and those condos would be sold 3 or 4 times before they were actually built. It was a wild and unhealthy time to be in the housing market for sure.
Wow, crazy. That is insane. So for that negative amortization loan as well, every single time you make a payment, your loan balance just keeps on increasing then, right?
Of course, every
Yeah,
payment that's less
insane.
than fully amortized goes up. Yep.
Yeah, the thing that a lot of people don't realize too is that the lender was basing your underwriting standards, if you want to call it that, based on the initial teaser rate as well. So you can do
Yes.
like a interest only payment. It's going to adjust in whatever 3, 5, 7 years, and they're basing your qualification purposes based on that teaser payment, which is absolutely insane because
And that's, yep.
you have a $500 payment and then increases to $2,000 in year 3, but they're basing your qualification based on
That is why everything blew up in 08. Because people may not know this. You can go back and research this. 51% of mortgages that originated in 2006, were some type of variable rate interest. I think it's like 17% were these most toxic pick a payment. But the problem was, you're absolutely right. All of the underwriting was on the 1.9. And then at the 2-year mark, it reset to 9.9.
So insane. Yeah,
That
can you
is
imagine like the
bananas.
rate going up, but also you're paying principal and interest later, whereas right now, or the first several years or whatever it is, you're paying only interest only. So in an environment in which rates were increasing, it also is, by the way, not a 30-year fix, it's a variable rate. I mean, it's absolute disaster of a loan product.
And that is the first thing for the folks that say we are going to repeat the Great Recession is different. Again, 06, 51% were variable. I think the numbers today are about 7 or 8% of loans are adjustable rate mortgages. Teaser loans are illegal now. They don't exist. So they're not out there as a product. But for most of us, our living expenses now are fixed because everybody has a fixed rate. Something like 80% of us are below 5%, 70% below 4, whatever it is. Our housing costs, generally speaking, are fixed, and they're certainly not going to quadruple going from 2 to 9. It's just not the same mixture is 08.
Yeah, absolutely true. And for a 30-year fix, I mean, your principal and interest is fixed for 30 years. Of course, we all know about the increase in home insurance, HOAs, and of course, property taxes as prices are increasing. But at least you have your principal interest is fixed. And on top of that, if you live in California, we of course have a tax on the amount of our tax assessed value that can go up. Basically the estimation of the value of your property per the tax assessor's office. We have a cap on that in California, which basically goes up in line with inflation, historically speaking, and not for the past several years, of course. So great. Yeah. I think it's really important to kind of get some insights regarding that. When I bought my first property in 2005, I did a 7-1 ARM. So 7 years fixed, but it was interest only. And then after year 7, it would adjust to, current rates and also principal and interest as well. So one thing I really is really fascinating regarding your story. We shared that we have some commonality here. We're both past accountants. I still have a CPA license, but it's been inactive for over 10 years. I worked as an auditor for KPMG, a financial advisor, financial analyst, et cetera. And I know you worked as an accountant as well. How in the world did you move from a W-2 employee to amassing, such a ginormous rental property portfolio, over 180 units that you have for rentals? How in the world did you do that?
Well, there were a couple of life events, I guess we can go through. The first one, frankly, is in my W-2. I chased income. I chased money. Accountants don't make a lot of money. So
Yep.
I was an accountant at Quantum Disk Drive. You can find all these on my LinkedIn profile. Quantum Disk Drive, just a lowly accountant. I think I was making 37,000, 36, something like that a year. They were implementing a software product called Oracle. I was brought onto that team as a financial expert. That gig, that project was successful. I was then recruited to Sun Microsystems,
Hmm.
where I went over to the IT side as a consultant. Again, instead of being the domain expert, I was now the product expert helping Sun Microsystem implement Oracle. That was a large bump in pay. I then was recruited by a small software company called Chainlink. Again, all this stuff's on LinkedIn, to come over and help them with pre-sales for an Oracle tool. Again, which is really, really interesting because I was an accountant. I'm not a computer scientist. I don't write code. I'm not an engineer. And lo and behold, I was put up against those types in this career, and I crushed them. I beat them all. And that little pre-sales, job led to a sales job, led to grow to market. And I just kept climbing the corporate ladder was the first answer. So I chased money, chased income, chased stress, all of that. Second, we got ridiculously focused on cutting expenses.
Hmm.
We were like a lot of Gen Xers. We were living paycheck to paycheck. We made 100, we spent 100, right? Whatever came in, we spent. And in order to build wealth, you need discretionary income. And, once I lost all that money in the stock market, we got really focused on a budget and reducing our expenses. So we had investable capital. And, from there, we just got going, right? We bought that house on Norris Drive. I think we had 6 houses in a duplex. We had 8 units in 2006. I went to a real estate meetup with the legend Bruce Norris out of Southern California at the time. He's now in Florida. And he issued a report, Jason, called California Crash. Let's just say that report got my attention. I am now a balance sheet millionaire, right? We've got these houses that have all roughly doubled, and I'm happy. But I also have in the back of my mind that we almost lost everything in the .com crash. I have no interest in losing everything again. And I don't understand half the things that Bruce says, but I do catch on to the thing that he said, affordability index. There's this thing called the affordability index, which basically says how stretched the housing market is. Mm-hmm. And the beauty of the affordability index is it's by MSA or by county. And I knew enough to take notes. I knew enough to research. What I found in my research very quickly was Fresno, my market of choice, was the least affordable it had ever been.
Wow.
That was enough for me to go, oh, something's going to happen. So we decide to execute. We sell Norris Drive. People can look it up on Zillow, 1818 Norris Drive East, 93703. We bought it for 107. In just over or just under 3 years, we sell it for 263, more than doubled. And we take all of that equity, which is well over 100 grand, and 1031 it into a small apartment building that we still own today. Then we sold the next one. Then we sold the next one. Then we sold the next one. We go from 8 homes to 80 units, all apartments. And lo and behold, the crash happens. My market of Fresno, California, Norris Drive goes from 263 to 300 at the peak and crashed to 75. So if I had not taken action, gotten out of the way, I would have been wrecked. I would have been ruined. But thankfully, once again, I took action and moved on. And we were sitting in multifamily. Multifamily prices were depressed, so we got great deals. Our cash flow almost went up 1,000%. Almost, I think it went up 8x. And wow. We were living great. So then the crash happened. We didn't buy anything for about a year, maybe 9 months. And then we started buying, all the way down. We started buying Norris Drive. So it was at 300. We start nibbling at 150. And again, Norris Drive falls all the way to 75. So we had no idea where the bottom was. Mm-hmm. I knew a crash was coming. I thought worst case 30%. it actually went down 75% because of the toxic arms and pick a payment. Why are you going to have a $500 payment go to 2,000 when rent's 900? It just didn't make sense. So yeah, the inventory would come
0% down, right?
Yeah, it's crazy.
5%, whatever. Yeah.
Yeah. So, yeah. So that was really the big leap was 1031 exchanges. And then we were very active during the crash. We were buying houses again for, less and less money. So that's how we did it.
Yeah, my question for you on that. So you're doing 1031 exchanges. So you obviously are not realizing the capital gains, not paying income taxes on that. You just move your basis into a new property. But how are you moving to single family houses to apartment buildings? Because were prices for apartments, so suppressed compared to single family during that time?
They were depressed, man. Absolutely right. You want to know why, Jason? Because that was 2006, 7 were the worst years to be a landlord. Move-in specials, half off rent, all of that. Why? Because I would routinely decline tenants for income or credit, and they would call us back and laugh at us because they bought a home.
So insane. That is so insane. So they're getting disqualified for renting, but they're easily being able to purchase a house. Absolutely mind blowing.
So that's why I could sell at peak prices and buy at depressed prices.
Wow. So that was like perfect timing. Insane. Hindsight's 2020.
Very good timing. Yes, very good timing.
So one thing that's kind of interesting about that is that you were saying that Fresno was at all-time record lows for housing affordability back then. And of course, we're seeing that kind of right now as well. Affordability nationwide is at very low levels. I think the National Association of Realtors, they released their, I forget what it's called, their housing affordability index. And the last time they announced that, I think we're at all-time record lows for housing affordability. So how do you compare now compared to what you saw back when you were selling properties?
So again, I look at it quarterly. Again, because this is like an indicator of potential problems ahead. It is certainly bad. It is not 06, 07 bad. It's probably in the top 5. Again, if you look at it, I've looked all the way back to 1970. That's as far back as I've chosen to go. But yeah, still to this date, 1981 is the worst. That's what on a national level, 1981 is the worst. 1982, a close second. Today, actually last year, 2023 was worse than this year. We've seen incomes go up this year on real-time basis, and rates have obviously come down. So this year is actually more affordable than last year. Last year was the 3rd worst ever. This is probably the 5th or 6th worst year, but it's trending the right direction. I think housing is stuck in the mud on an appreciation basis for the next 3 or 4 years. I think housing on a decade by decade basis only goes up so much. And I think for the 2020s, we've already seen it. It's already gone up, whatever it is, 30% this decade. There's not much more left. We just got to go sideways for a while.
Yeah. And why do you feel that is? Because we had so much appreciation over the past several years, and then we have still elevated prices, and we have homeowners who have, basically are sitting on 2.5 to 4% rates and they're not selling. So
I think there's a couple of things. I think affordability matters because, again, I think a lot of the housing market in general starts with entry-level housing. And right now it's hard. It's not the hardest ever, like some people want to make it seem, but it is undoubtedly hard. But really why the housing market is broken is because we've killed the move-up buyer. If you know anything about the existing home market, the meat and potatoes of that market is what's called the move-up buyer. Why is the move-up buyer meat potatoes of this market? It's because there are 2 transactions. They're selling the entry-level home and they're buying the upgrade. Historically speaking, the turnover rate is about 8 years, right? You would turn over your homes about every 8 years. Given that the Fed broke housing, and meaning that the entry level is not being sold or it's being kept as a rental, it would not shock me if in 5, 6, 7 years turnover goes up 50%. We might see the turnover at 12 years. That is just fundamentally going to keep us, in the low 4 millions for transactions. I think the number that comes out tomorrow, or it might be Thursday, for existing home sales is going to be a cycle bottom. I think we're going to break below 3.88 million, which is currently the bottom. And it's because the move-up buyer is dead. Entry-level buyers are distracted by an election and higher rates. They don't want to have that financial commitment the rest of this year. I think the existing home market is going to be below 4.2 million transactions for the next 1 to 3 years.
Yeah, interesting. Last year, so I did some research on this. Based on the number of houses that have been sold so far, that's according to NAR. I think you're right too. I think we have an existing coming on Thursday, I believe, sometime later this week. In any case, so the number of houses we've had that sold nationwide are actually lower compared to the same time frame last year. So we're basically on track to have fewer home sales this year than last year, which is absolutely insane because last year was what, a 27-year low, lowest since 1995.
Exactly.
So we could get into a scenario in which we have less than 4 million existing home sales this year. Last year we had 4.09 million, I believe it was.
Or 1 rounded,
Yeah, 4.1 rounded up. So yeah, it's just absolutely shocking to see lack of transactions. But I think we saw a huge correction in sales last year, and we're kind of continuing on that trend. Lack of transactions occurring right now, but that does not mean that the housing market's crashing. It just means
it depends. It depends. I would argue, and one of the things I will take credit for is I told people 2 years ago when at that Jackson Hole meeting that we were going to have a housing crash, and then I went ... in transactions.
Yeah, right. Yeah.
Everybody talks housing crash like prices, right? Mm-hmm. We've got Pretty Chart Boy and all his brothers in arms talking crashes for years now. They don't know what they're talking about. This is not set up to have a monster wave of inventory a la the Great Recession that forces prices to come down. People are stuck in 30-year mortgages, and it's cheaper than rent. The reason 06 happened and then 08 and 10 happened is because it was cheaper to rent. And in many cases, a lot cheaper. Yeah. So they got out. So unfortunately for the people, once again, calling for a crash in 2025, they're going to be wrong. It'll be the 15th in a year in a row they've been wrong. Yeah. Residential housing is not set up to crash. That said, I do think we're in a small window where it is a buyer's market. I do think, I called this about 6 weeks ago. The buyer's market starts. I think it goes till January 15th, maybe February 15th, because Jason, as you know, sometimes people have to sell. Death, divorce, job transfer. And when you have to sell and there are no buyers, you're going to be open to what I call a disrespectful offer. And some of those are going to say yes. So I'm encouraging people to do the work, watch days on market, figure out what an average deal is and write those disrespectful offers, follow up, because they're going to say no the first time, maybe say no the second time, but you never know what happens when you follow up the third or fourth time.
Yeah, absolutely. It's good advice. I mean, especially for houses that have been sitting on the market for quite some time. If you write a super lowball offer on day one, I mean,
no,
the chances
don't do
of them
that.
accepting that is like fewer and far between.
No, let me be very clear. Don't do that. What I would tell you to do, everybody's market is different, is find your current days on market. Let's just say it's 28 days. I personally wouldn't do my strategy of disrespectful offers if the median's 28 until you're day 40. I want real signs of not moving. I want the agent to be having uncomfortable conversations with the seller, saying, we've had no showings at the open house. We've had no offers. I want that situation to get a little uncomfortable so that my offer is not really seen as disrespectful. It's at least seen as a white knight, as something to talk about. So yeah, don't do first day listings. That's silly.
Yeah, I totally agree with you. And not just like giving them an offer for what their house is worth in 2019 either. Look at the comms. Focus on houses that have been sitting in the market for quite some time. So let's talk about the NAR settlement as well. So some people think that, this is going to change the housing market drastically. They're waiting to see what's going to happen. What's your thoughts about how it's going to impact our housing market?
Well, I think there's a short and long-term impact. I think short-term, it has just made it harder for first-time home buyers, right? First-time home buyers, this is going to be their biggest acquisition likely of their life. They don't really know how it used to be. All they're hearing, right? So maybe some of this is educational, is they might be on the hook for paying their buyer's commission. That's what they're hearing, right or wrong. Experienced people like me, it's like, it's another line item of negotiation. No big deal. But those first-time home buyers, you got to remember they've been scraping by to save 3.5% or 5% down. The last thing they want to turn around and goes, oh my God, I got to pay 1%, 2%, 3% to my agent as well. Well, that's another year of savings. So I think, unfortunately, in the short term, 6 months or so, it's just made more first-time home buyers go too hard. I'm nervous. I'm scared. Longer term, when this gets kind of wrinkled out and it becomes more status and more people understand it's just a negotiation, maybe it unlocks, but certainly through 2024, it's not helpful. It doesn't help first-time home buyers buy more homes. It's a huge net negative to buying a first home, in my opinion.
Yeah, I agree with you. What I'm hearing from real estate agents, in California and other parts of the country as well, is that they're not seeing a whole lot of pushback on the commission. So when you write an offer, at least here in California, which is probably similar to other parts of the US as well, you write in there how much you're asking for or to be paid as an agent for representing the buyer. So that's all part of the negotiation of writing the offer. And I personally haven't seen a whole lot of pushback on that. I haven't heard a lot about pushback on that as well, where sellers, just like in the past, are negotiating terms of the offer, whether it's the price, closing costs, etc., but not too much regarding the commissions being paid to the agent. So I'm not seeing a whole lot of pushback just yet.
I think for the experienced folks posted multiple transactions, it's a nothing burger. But again, if we really step back and look at the entry level, the first time home buyer, it's like adding sand to the gears. It makes it more hard, more uncomfortable, more unknown. So yeah.
Right. Yep. Totally makes sense. Any predictions for next year?
Yeah, I think for the next, when I talked about 2024, I said basically flat. Flats plus 1 or down 1%. I'm going to carry that into 2025. I think I don't see us getting above 4.2 million sales transactions, which, oh, by the way, might be up 5%, which would be pretty wild if we end at 3.8 or something, which is kind of funny, which will be up. But yeah, I don't think prices go anywhere. I think we got all the appreciation. I think if we had, maybe 2.5 would be kind of a max. Something else I did, again, I talked about doing stats back to 1970. Here's an interesting stat for you, Jason.
Yeah.
If you look at the nominal home price for the last 50 years, you got to guess at how much it's gone up on a nominal basis?
For existing houses?
Yeah, existing homes.
Yeah. Nominal. So not inflation adjusted. I'm
Correct.
Guessing 1,000%.
I think it's actually 1,100%. So it's 11x. You were close. Now, if we adjust for inflation, AKA real, what do you think?
I'm guessing, so total from 1950 to now?
1970.
1970 and now. I'm guessing it's going to be probably around 60%.
Not a bad guess. Most people are way off. It was 110%. So
right.
Nominal 1,100, so 11x, adjusted for inflation, just over a double. Right. So again, but the beauty of that statement is debt, right? I say this all the time. Inflation's a feature, not a bug. So if you can buy an asset that goes up in value and rents go up, but the debt goes down in value, that's kind of a grand slam, to use a sports word.
Yeah, it's a great analogy, especially for areas in which you're not seeing like huge increases in insurance, because areas like in Florida, these,
the Gulf Coast. Yeah. The Gulf Coast is bad shape.
Right. Bad shape. Okay, well, I know we're running out of time here. Michael, I appreciate so much for joining us for the first time on the channel. Hopefully, one of many. Really appreciate your insights you provided.
Jason, I appreciate you, man. Thanks again.
Yeah, thank you. And everyone who is not familiar with Michael, he has a YouTube channel, of course, one rental at a time. I'll provide a link in the video description below. Please check out his channel. He posts about one video per month, I think, right?
I post 3 or 4 videos a day.
I'm just kidding. How many videos?
3 or 4 a day.
I know. Yeah. You're a machine when it comes to posting out video, pumping out videos on YouTube. It's absolutely insane. But anyways, yeah, appreciate it for you joining us on today's video. Please like and subscribe. Hope you guys have an awesome day, and we'll see you on the next video.